Good day, fellow investors. We are getting stronger. A great quote from Henry Youngman: Americans are getting stronger. 20 years ago, it took two people to carry $10 worth of groceries. Today, a 5-year-old can do it. So we are certainly living in an environment of inflation. But when it comes to investing, inflation might be passé. We should start focusing on investing with rising real interest rates, maybe, because inflation, the time to invest for inflation was 2-3 years ago. Now it's a little bit different. So something else what I want to share today is perhaps something to think about. So we'll discuss the current investing situation, we'll compare historically, we'll discuss the best investment vehicles for the current environment, and as always conclude with a long-term value investing perspective. Let's start. If you enjoyed the video, please inflate that like button because it really helps supporting the channel. And if you haven't, please subscribe and smash that notification bell so that you get notified for the kind of videos you like, because we do from macro to detailed stock analysis. And let's now start with the current investing situation. Inflation is clearly already here. So if you invest for inflation now, maybe you are a little bit too late, because this was the time to invest for inflation. You have to prepare for something when it hasn't happened yet. Now you might be too late, because inflation is here. Energy prices, commodity prices have already boomed. Inflation is global, so wherever you look around the world we have inflation, except for China, but maybe as they come out of the lockdowns that will happen there too. Inflation is pressuring spending, so the first time we have seen a slow spending decline. It looks like it will attack consumption, that might lead into a recession, but then again people think that the Fed will manage to do a soft landing, but we'll see about that. The problem is that inflation, to be countered, you need to increase interest rates, and with higher interest rates, all those burdens, those debt burdens, like here the net interest payment of the US government at 400 billion, those burdens go higher, and therefore it's very difficult to increase inflation without spending and without hitting also net interest expenses, and thus increasing the deficits that are projected to remain there likely forever, year after year, because it seems that we are in an environment where you can borrow into eternity. So the Fed expects to push rates to almost 4%, which should then lead to 5, 6, 7% at the 10-year Treasury, but the market here already expects that the Fed will not be able to push that higher because of the impact on the economy. Thus, if there is a recession, we could also see lower inflation, which means that the Fed will not have to push rates this high as expected. The current investment situation says that the Fed is increasing rates, which should lead to increasing real rates, which creates an environment of higher rates for us investors. So higher real rates might be the thing to focus on before focusing on inflation. We have focused on inflation 2 years ago and we did pretty good, especially with our commodities. Druckenmiller said that it is impossible to curb inflation above 5% without hitting the economy, and we will see how it goes about that, because nothing is certain in this world. Yes, historically, only when Volcker pushed rates significantly higher, only then they were able to curb inflation. And you have these ups and downs in rates and recessions, and the market was crazy here in the 70s, but only when a significant step was made, only then inflation was solved. And you can see here the 10-year Treasury was at 15% interest rate and Fed rate was at 20%. This is really something that we don't even think about now because it would be terrible. However, it is a possibility. So nobody knows where inflation will go, but now we might have this to worry, which is rising real rates. For now we are still at negative rates, but as rates go higher, we should see higher real rates. So if I pull out the chart that shows the real returns on the Dow, you can see here that from 1966, when the issues slowly started with inflation and everything, a few recessions, the market in real terms went down 75% from 8,000 something to 2,500 and lower. So those were terrible years in real terms, and only here after the big recession in 1982 caused by higher interest rates, only then things cleared, and then we had the boom, the 40-year bull market that we have enjoyed till now. And now one might ask, okay, Sven, how to invest? We already had inflation. What does well in this environment? So 75% down in real terms, and if I turn off inflation adjusted returns, zero returns for 15 years. This is really something remarkable and something to watch for. However, there is a solution. In the period from 1960s till 1982, value stocks, the lowest percentile, the lowest 20% of price earnings ratios, thus value, did 10x. While the rest of the market did 0, value did 10x. So imagine the discrepancy there. Value 10x, market 0. That's what I call value investing. That's why it is important to be a value investor, because when everyone is excited about the market arc, this and that, okay, great, let them make money. But the core of investing is to do well in those periods where everybody hates the market, nobody's in the market. Then you accumulate wealth, then you make your 10x, and the rest is history. The difference is incredible. So I repeat myself, investing is about doing well when others are doing terribly. And I recently did a video on Tesla, really wanted to say why I avoided it for the last 7, 8, 9 years, why I'm happy that I missed the 10, 20x that all of you did on it, because now when things get ugly, when things get tough, I want to do okay in a bull market, but I want to do even better in a bear market. And for that, you need to focus on value. Stagflation, inflation, rising real rates, whatever happens, focus on value and you'll do okay. That's the key. And let's now discuss the best investments for the current environment. This is a very important chart. So the Argentinian stock market over the last 30-40 years. The level was around 1,000 up to 2007, and then as inflation hit in, it started going higher and higher to the current 100,000. So the market is a 100x over the last 20-something years. So 100x is really something. But if you look at the currency went down from 1 to the dollar. The peso was fixed here, 111, and then when it left the fix, then it declined 99%, even a little bit more. So complete destruction of currency. But how to invest when there is complete destruction on currency? Of course, real assets give you protection, at least something. If you hold pesos, you have been destroyed here. But if you held businesses, okay, you at least had something for the currency destruction. And given the debt, given the environment, we are living in an environment of fiat currency where it is clear that the currency will be devalued over time. This is what governments have been doing since the invention of money, so that is a key fundamental to understand. Currencies will be worth less. Owning businesses is a way to keep your wealth, protect your wealth, accumulate wealth over time. That's one. Then discussing of real rate increases. So there is something a little bit different. Inflation is one, but yes, real rates increasing is another environment that we can discuss. I found this beautiful chart on Vanguard, and you can see here how high quality value does really well when real rates go higher, except in the recent boom while the Fed was still printing money hand over fist. International equities do good, emerging markets mostly, depending also on the price paid. Value stocks, okay, US equities, okay, small caps, okay, and then what gets clobbered is high quality growth, still can be, but growth stocks in general, and we have seen that over the last few months, bonds destroyed. Home prices also get pushed below the median relative returns. Commodities, as we said, maybe too late, and I know a lot of you rushed into commodities at peak because of fear, but that's usually the wrong way to invest. Low quality growth, terrible. Bonds on aggregate, a terrible solution, both in inflation and both with rising real rates. So as said, maybe too late to focus on inflation, let's focus on quality now. When it comes to other asset classes, gold, it can be a part of your portfolio, but there is too much noise. Of course, you have to buy it when nobody wants to touch it with a 10-foot pole and then sell it when everyone is excited about it. Bonds are definitely terrible. Real estate depends first on the project you find. There is always a value depending on how much you want to bother with it. If not, you just get the rent and that's it. You should be happy. It depends, of course, on rates, economy, but hard to bet. If you have some money that you need soon, then yes, if you're from the States, treasury inflation protected securities, I think there is a limit to 10,000, but that can be something interesting if you need the money sooner. Digging deeper, as an inflation hedge, as something that works no matter what, always go for stocks, because if you look at real returns, treasury bills, bonds don't do very well. Stocks do usually pretty well as you own the businesses. And this return, your return, depends on the price you are paying. That's first and foremost. And if we go to the Bible of value investing, The Intelligent Investor, that was last written in 1972, then we can see also what Benjamin Graham says about investing in related to inflation. What's very interesting is that the inflation chapter in the book was pretty much irrelevant for 40 years because we haven't had high inflation. So why is this guy, the genius, putting it in the second chapter? So he might have sounded a little bit lost for 30 years, but now the second chapter is very well in place again. And he simply says that bonds are terrible. In the 70s, those were called certificates of confiscation because you get less and less value back when the bond expires, so you're toasted there. And then owning businesses is the best answer. But always focus on the price paid and what kind of businesses you own, because it depends on the price paid what kind of return you have. You can pause this video and then look at the table. This is from Benjamin Graham, of course. And you can look at the table and you can see how stocks reacted to higher or lower levels of inflation. It is not really that straightforward because inflation in the 70s didn't do great for stocks. Sometimes it does good, sometimes it does bad. It depends on your starting point. In 1950s, so the stock market went up significantly. Consumer prices didn't go up that much. The 1920s, consumer prices went up. The 5-year period, early 1920s, stock prices didn't do much. Later, we had deflation for 5 years. Stock prices went up, again up. So it depends on the price paid. There is not a clear linear correction, but over the long term, stocks should give you protection on your value if you own good businesses. And then something very important, with low interest rates, with low inflation, what do businesses do? They borrow, because that's the smartest thing to do. If you can borrow at 1% and invest for 3%, you are a genius because you get the 2% spread. But when rates start rising, you are toasted. Because if we look at the debt of corporations, this is for the United States, but before the great financial crisis, the debt crisis, general debt was at 6.5 trillion. Now, after the crisis, how do you solve a crisis? You give more money, you create more debt, and now we are at double what we had when it was the big debt financial crisis. You are putting out a fire by adding gasoline on it. So this is a big risk, because now as interest rates start rising, real rates start rising, this becomes an issue for companies, burdens companies, and lowers their earnings. So you really have to select what you're going to invest in. And here is returns on inflation, and you can see that returns go up and down. Stocks prefer stable prices, then you don't have great swings, mostly positives. When inflation is higher, then the market looks for direction and you have these swings, positives and negatives. So that's also something to think about. With deflation, usually also stocks don't do really well. So very interesting chart. Of course, investing, it comes to the price paid. There is no certainty. You have to think, okay, what's the risk? How does my business work in a certain environment? Of course, more debt is more risk, so keep that in mind, and then build and accumulate wealth over time. That's the best message I can give you. The more margin of safety, the more value, no matter what you have, the better your portfolio will look like 5-10 years down the road. That's the core of investing. And first and foremost, when you're buying something, when you're investing, think of price. How much am I paying for what I'm getting in return? We just did 10 dividend stocks and the yield is 2%. Crazy low. Can I find better? If you can find good businesses with 5% dividend yield, that's already a 50% discount on price, and immediately your long-term returns will be double. And for now, we are still in an environment where value is relatively cheaper than growth, so looking through value pays. And I'm looking through all the dividend stocks of the Vanguard high dividend yield. I'm down to 70. When I do 100, I'll select a few to give you the best, to try to find better and better to fill our YouTube portfolio, so that we create as much value here and focus on the value part, that no matter what happens in the economy, we do good. For that, please subscribe. If you want deeper analysis, check what I do on my research platform. There we have some really good value buys for whatever comes next. I'll see you in the next video.